Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Hawkins, Inc. quarterly report. Hawkins, Inc. is a multifaceted company that operates through three distinct segments: water treatment, industrial and health and nutrition. The company's services and products cater to various industries, including water treatment, agriculture, chemical processing, electronics, energy, food, pharmaceuticals, and plating. The water treatment segment provides comprehensive solutions for potable water, municipal and industrial wastewater, industrial process water, non-residential swimming pool water, and agricultural water. This includes chemicals, equipment, services, and products to ensure safe and clean water supply. In the industrial segment, Hawkins offers a wide range of industrial chemicals, products, and services to various industries. The company manufactures sodium hypochlorite and agricultural products, as well as food-grade and pharmaceutical products such as liquid phosphates, lactates, and other blended products. Additionally, it repackages water treatment chemicals and bulk industrial chemicals, and performs custom blending of chemicals. The health and nutrition segment provides ingredient distribution, processing, and formulation solutions to manufacturers of nutraceuticals, functional foods and beverages, personal care products, dietary supplements, and other nutritional food and health and wellness products. Hawkins offers a diverse range of ingredients, including minerals, vitamins, amino acids, excipients, joint products, botanicals and herbs, sweeteners, and enzymes. Overall, Hawkins, Inc. is a leading provider of water treatment solutions, industrial chemicals, and health and nutrition ingredients to various industries across the United States. Hawkins, Inc.'s stock price surge. A year of unprecedented growth in the past year, Hawkins, Inc.'s stock price has experienced a remarkable increase of over 30%. Reaching an all-time high of $186.15 in August 2025. This surge can be attributed to several key events that have contributed to the company's financial growth and market recognition. One of the primary drivers of this growth is Hawkins' strong financial performance, particularly in its industrial segment, which saw a 10.8% increase. The company's water treatment business also showed overall growth, with organic increases across all segments, surpassing earlier estimates for fiscal year 2025. Additionally, Hawkins exceeded earnings and revenue expectations, announcing adjusted earnings per share of $0.78 against a projected $0.73, and revenue of $245.3 million, surpassing the expected $227.99 million. The company's strategic acquisitions and expansions have also played a significant role in its growth. The acquisition of Philtech, LLC, a manufacturer and distributor of water treatment products, strengthened Hawkins' market position, while the expansion of its water treatment footprint through the acquisition of Redbird Chemical assets in Texas further solidified its presence in the industry. Furthermore, Hawkins has demonstrated exceptional revenue growth and net margin, outperforming its industry peers in the materials sector. The company's recognition and accolades, including multiple workplace and corporate awards, have also highlighted its broader business strength. The positive future outlook for Hawkins, Inc. is evident in its projections of surpassing $1 billion in revenue for fiscal year 2026. With record sales and EBITDA achieved in fiscal year 2025, the company's financial momentum continues to build. The recent release of record Q2 fiscal 2026 results with sales up 14% to $280.4 million further underscores Hawkins' commitment to growth and excellence. In conclusion, the significant appreciation of Hawkins, Inc.'s stock price over the past year can be attributed to a combination of strong financial performance, strategic acquisitions, exceptional revenue growth, and positive future outlook. As the company continues to expand its market presence and achieve record-breaking results, investors remain optimistic about its future prospects. Hawkins, Inc. maintains a market capitalization of $3 billion, broadly in line with the industry peer group. Hawkins, Inc. trades at a higher price-to-earnings ratio of 39 times and a higher price-to-book ratio of 6.91 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. The company maintains a moderate leverage profile, with liabilities making up 40% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have increased consistently as the company expands. Importantly, both assets and shareholder equity have grown at least 20% faster than liabilities, indicating that the business is expanding substantially and generating value after covering its obligations. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline can be identified through an analysis of the company's performance across its various segments. In terms of revenue growth, the water treatment segment saw significant increases due to sales from acquired businesses and improved pricing on certain products. The food and health sciences segment also experienced growth, driven by acquisitions such as Water Surplus, Inc., which contributed to a 30% increase in revenue. In contrast, the industrial solutions segment saw a decline of 7%, despite added revenue from the Amerocum acquisition. This suggests that while strategic acquisitions can drive growth, they may not be enough to offset other factors contributing to decline. The water treatment segment also experienced a decline, with sales decreasing by 22%. However, it's worth noting that this was largely driven by external market conditions rather than internal performance. Overall, the primary drivers of revenue growth or decline appear to be influenced by a combination of strategic acquisitions and external market pressures. While acquisitions can provide a significant boost to revenue, they may not be enough to offset declines in other areas. The net income of a company has undergone significant changes over the past year. In Q3 2025 compared to Q3 2024, the net income decreased by $709,000. This decline was accompanied by a decrease in gross profit margin from 21.4% to 20.8%, indicating that the company's ability to convert sales into profits has been impacted. Looking at the year-to-date YTD performance, the net income decreased by $1,933,000 compared to YTD 2024. However, when examining the 9-month period ended December 28, 2025 versus the same period in 2024, the net income actually increased by $51,064. The overall trend for fiscal year 2026 is a decrease in total net income from $14.31 million to an unspecified amount. The reasons behind these changes are multifaceted. A significant contributor was the decline in sales within the food and health sciences segment. Additionally, the company incurred increased interest expenses due to higher borrowings to fund acquisitions. Furthermore, selling, general, and administrative expenses rose as a result of added costs from acquired businesses. These factors collectively contributed to the fluctuations in net income and profit margins over the past year. The company is indeed generating positive operating cash flow, indicating a healthy financial position. The data from various pages of the report confirms this trend. For instance, on page 10, it is mentioned that net cash provided by operating activities for the 9 months ended December 28, 2025 was $106,592, which is an increase from $80,252 in the same period a year ago. Furthermore, on page 12, the operating cash flow for the 9 months ended December 28, 2025 was reported to be $66,239. This figure also shows an improvement over the previous year's operating cash flow. Additionally, on page 24, it is stated that cash provided by operating activities for the 9 months ended December 28, 2025 was $106.6 million, which is a significant increase from $80.3 million in the same period a year ago. These figures collectively indicate that the company is generating positive operating cash flow, which is a crucial indicator of its financial health and stability. The company's financial situation has undergone significant changes in recent years. One notable change is the increase in long-term debt, which has risen from $138,906 to $253,375. This increase in debt is also reflected in the total liabilities, which have grown from $309,575 to $457,620. However, it's the interest expenses that have seen a more dramatic shift. For the 3 months ended December 28, 2025, interest expenses increased by $2.2 million to $3.4 million compared to the same period in 2024. This represents a significant jump of 183% year-over-year. Looking at the 9-month period, the increase is even more pronounced. Interest expenses rose by $6.6 million, or 168%, to $10.5 million for the 9 months ended December 28, 2025 compared to the same period in 2024. These changes indicate a substantial increase in interest expenses, which may have significant implications for the company's financial health and profitability. Management is shifting the company's focus towards becoming a specialty ingredients provider, moving away from bulk commodity distribution. This strategic shift aims to drive growth through acquisitions of value-added/specialty ingredients businesses. The company expects increased revenue due to these acquisitions and improved pricing. To achieve this goal, management will prioritize cost control, efficiency improvements, and investments in manufacturing, blending, and repackaging products. Financial performance will be evaluated based on operating income rather than traditional metrics. With a strong financial foundation, the company believes it can fund ongoing operations through cash balances, credit facilities, and cash flows from operations. This strategic direction positions the company for long-term success and growth. The company's financial activities over the past year have been notable. One of its key actions was paying out cash dividends to shareholders. This move demonstrates a commitment to rewarding investors for their loyalty and support. In addition to dividend payments, the company also engaged in share buybacks. Although no shares were repurchased in 2025, this strategy is often used by companies to boost shareholder value and reduce the number of outstanding shares on the market. The company's use of the LIFO inventory valuation method poses concerns about inventory buildup and supply chain disruption. This accounting method can lead to higher costs for recent purchases, potentially resulting in an accumulation of inventory if not managed effectively. Furthermore, a decline in sales of bulk commodity products in the industrial solutions segment from 25% to 21% in the current quarter compared to the same period last year suggests a shift in market demand. This change may indicate a potential disruption in supply chain operations as companies adjust to new market conditions. That concludes the financial summary for Hawkins, Inc. Feel free to comment below, and I will be happy to answer them when possible.